Do you know how crucial it is to monitor and adjust your investment portfolio? If your answer is no, or even if it's yes, stick around, because today, we're diving into the importance of keeping a keen eye on your investments. Think of your investment portfolio as a garden. Just as a gardener nurtures and tends to their plants, an investor must monitor and adjust their portfolio. Without regular care, plants may wither, and similarly, investments can flounder. But with consistent attention, both gardens and portfolios can flourish. Monitoring your investment portfolio regularly is crucial for several reasons. First, it allows you to track the performance of your individual investments. Like checking the growth of each plant in your garden, keeping an eye on each investment helps you understand how they're doing. Are they growing as expected? Are they struggling? This information can help you identify any underperformers or areas of weakness within your portfolio. Understanding the performance of each investment is like having a health checkup for your financial garden. It provides you with valuable insights that can guide your investment decisions. For instance, you can decide whether to hold on to a particular investment, sell it off, or perhaps reallocate your resources to another area that might offer better returns. Another important reason to monitor your portfolio is to review your asset allocation. Over time, the value of your investments may shift, causing your asset allocation to drift away from your target. By keeping track and making adjustments as needed, you can ensure that your asset allocation remains aligned with your investment objectives and risk tolerance. Lastly, staying informed about market developments is essential in this process. Just as a gardener needs to know about weather patterns and seasonal changes, an investor must follow financial news, read market analyses, and stay connected with trusted sources of information. This knowledge will allow you to stay abreast of market trends and economic indicators that may impact your investments. So there you have it. The key to successful investing lies in regular monitoring and making informed decisions. Just like a well-tended garden, a well-monitored investment portfolio can yield a bountiful harvest. Now that we understand the importance of monitoring, how do we evaluate the performance of our investment portfolio? Well, it's not as daunting as it might seem. Let's talk about some strategies. One common approach is comparing your portfolio returns to a benchmark. This could be a standard index like the S&P 500 or a custom benchmark tailored to your investment objectives. This gives you a reference point to understand if your investments are outperforming or underperforming the market. But remember, returns aren't the whole story. It's also crucial to assess the risk-adjusted return of your portfolio. This means considering the level of risk you've taken on to achieve your returns. For example, if two portfolios have the same return, but one has taken on significantly more risk, the less risky portfolio is typically seen as the better performer. Fees and taxes can also significantly impact your returns. Investment fees can eat into your profits, so it's important to understand what you're paying and why. Are these costs providing value, or are they just diminishing your returns? On the tax front, understanding the tax implications of your investments can help you strategize to minimize your tax burden, keeping more money in your pocket. It's also worth mentioning that evaluating portfolio performance is not a one-time event. Instead, it should be a regular part of your investment routine, allowing you to spot trends, identify opportunities, and make timely adjustments. And don't forget, evaluating performance is not just about numbers. It's about aligning with your financial goals and values. Are your investments helping you get closer to your objectives? Are they reflecting your values and risk tolerance? You see, evaluating your portfolio's performance is not just about looking at returns. It's about understanding the bigger picture. It's about ensuring your investments are working hard for you, helping you build wealth, and guiding you towards your financial future. And with these strategies at your disposal, you're well equipped to make informed decisions and keep your investments on track. Once we have evaluated our portfolio's performance, how do we adjust it for better outcomes? This is a question that every investor, no matter how seasoned, grapples with. Let's delve into some strategies that can help guide us through the process. Firstly, it's crucial to not shy away from the possibility of selling underperforming investments. Yes, it can be difficult to let go, especially when we've held onto them for a while, hoping for a turnaround. But sometimes, cutting our losses is the best course of action. It's important to be objective in these situations and base our decisions on data, not emotions. Next, we have reallocating funds. This can be a powerful strategy for optimizing your portfolio. Let's say you find a sector or a company that's outperforming others. It might be a good idea to shift some of your investment towards this high-performing area. But remember, It's equally important to maintain a diversified portfolio to spread out potential risks. Diversification, in fact, is our next point of discussion. It's like that old saying, don't put all your eggs in one basket. Diversifying your investments across different sectors, asset classes, and geographical locations can help reduce risk. If one investment takes a hit, others in different sectors or regions might perform well, balancing out your overall returns. Now let's talk about timing. Timing your adjustments is a skill that comes with experience and knowledge. Market conditions are ever-changing, and it's important to consider these changes when making adjustments. For instance, during a recession, it might be wise to shift towards more conservative investments, while in a booming market, taking on a bit more risk could be advantageous. Lastly, remember to be patient. Adjusting your portfolio isn't about constant knee-jerk reactions to every market fluctuation. It's about making calculated decisions based on thorough analysis and long-term investment goals. Remember, the goal of adjusting your portfolio is to optimize returns and minimize risks. So, don't be afraid to make changes when necessary, but always do so with a clear strategy and objective in mind. Have you heard of the term rebalancing? It plays a crucial role in portfolio management. Now, rebalancing is not about adjusting the radio knobs to get the perfect sound. It's a strategy used to realign the weightings of a portfolio of assets. It involves periodically buying or selling assets in a portfolio to maintain an original or desired level of asset allocation or risk. Picture this. You've set your investment portfolio with a 50-50 split between stocks and bonds. Over time, this balance may drift due to differing returns from your stocks and bonds. If your stocks perform particularly well, you might find yourself with a portfolio that's heavily skewed towards stocks. This might sound like a good thing, but remember, higher potential returns also come with higher risk. This is where rebalancing comes into play. Rebalancing is like a routine checkup for your portfolio. It helps to ensure your investments are still in line with your financial goals and risk tolerance. By selling off some of your overperforming assets and buying more of the underperformers, you can bring your portfolio back to its original asset allocation. But remember, rebalancing isn't a one-time event. It's a continuous process that should be performed regularly. Some investors choose to rebalance their portfolio on a fixed schedule, such as quarterly, semi-annually, or annually. Others might rebalance when their asset allocation drifts a certain percentage away from their target. However, keep in mind, rebalancing can potentially incur transaction costs and tax implications. So, it's always a good idea to consult with a financial advisor or tax professional before making any significant changes to your portfolio. Now you might be thinking, why go through all this hassle? Well, the answer is simple. Rebalancing helps to control risk and prevent your portfolio from straying too far from your investment strategy. It's like a compass, keeping your portfolio on course no matter how the market winds blow. Rebalancing is an essential tool to ensure your portfolio remains aligned with your investment goals. Lastly, the world of investing doesn't exist in a vacuum. Staying updated on market developments is vital. Markets are ever-changing landscapes shaped by various factors such as economic indicators, political events, and global trends. These elements can significantly impact your investments positively or negatively. Therefore, it's essential to stay informed about these developments and understand how they might affect your portfolio. To do this, consider following financial news. These sources often provide a steady stream of information about market trends and economic indicators. Reading market analyses can also offer valuable insights. These reports typically delve deeper into specific sectors or trends, providing a more nuanced understanding of the market. Additionally, staying connected with trusted sources of information can be beneficial. Whether it's a financial advisor, a trusted finance website, or a reputable finance podcast, these sources can provide expert insights and tips that can guide your investment decisions. Staying informed about market developments allows you to make proactive and informed investment decisions. So, we've covered a lot today, right from the importance of monitoring your portfolio to staying informed about market trends. We learned that keeping a close eye on your portfolio allows you to evaluate the performance of individual investments, spotting the underperformers and areas of weakness. This critical information is your guide to informed decisions about holding, selling, or reallocating your investments. We also delved into strategies for evaluating portfolio performance and making timely adjustments. The importance of rebalancing your portfolio as needed was another key point. Over time, the value of your investments may shift, causing your asset allocation to drift away from your intended target. Regular rebalancing ensures that your asset allocation aligns with your investment objectives and risk tolerance. And let's not forget, staying informed about market developments is essential for making informed investment decisions. Reading financial news and market analyses keeps you in tune with the pulse of the market. Remember, successful investing is a journey, not a destination. And in this journey, being proactive and informed is the key. If you found this video helpful, please like, share, and subscribe for more such insights. Thank you for watching.